Hey guys, we had two powerful trades today, all in the energy market. Crude oil and natural gas were big winners for us today. Let's go over the trades step by step. This is the retest of the opening range breakout. They worked out beautifully. I hope you got in on the two trades today in the energy market because it really put money in the bank. So let's go over it step by step using OTA trading view tools and going through our process. Okay. If you haven't watched the free mini course on the opening range breakout, please do that. Go back over the free trade plan that I had on the website. I want you guys to understand how powerful it is to line up your momentum filter on the high time frame with the middle trending chart. Whatever you use for a middle time frame, I use the 1 hour. Line that up with your high time frame momentum and you will get super duper trades on the opening range breakout retest. Okay, so let's get into it. Let's go to the high time frame here. We are using the daily chart, and the daily and the 4 hour were both lined up. Okay, we were cycling up, we had upward momentum. We absolutely love when that happens. Okay, that is very powerful. Now, at the time that we were looking at this, crude oil was not on our scanner. Okay, and let me show you why. The scanner picks up the strongest zones in the market. It was transitioning into that demand zone column. So you might have seen it flashing on and off today. Let me show you why. Do you see how the candle here on the middle time frame is still red, but the trend is green? We didn't get a green candle until right here. Okay, so right here, when price started to break out of our opening range, the candle did go green. And when we got to here, we were definitely in the green. Okay, but right here, we were still red. So it was flashing on and off. But look what we had. We had an upward cycle in the green. We had upward momentum in the green. Middle time frame, trend is up and it's green. The candles just didn't transition into the full upward trend color. Okay, so the algorithm was switching over to that strong upward trend. So this was a little bit of an aggressive move, but I hope you got in on it. There was plenty of evidence showing that you could take this trade to the upside. So what did we get? We actually got a breakout right here. It did pull back, and look what it hit. It pulled back and hit the previous week's low. And if you switch it onto the higher time frame here, you can see it right there. Previous week's low, pulls back, hits that level. Those are such powerful levels in the morning, guys. I highly recommend paying attention to that. Hits that level, breaks back above, and as we're transitioning to the upside, it's in a fight. So the buyers did come in. We did get the retest, and it was off to the races. So let's take a look and see how much this cost us. If you took the full range of this, you would have put your entry here. Your stop loss would go right below the opening range. It would have cost you $175. That's 4 contracts. You pulled up, you hit your first target, that's 2-1. You hit your second target, that's 3-1. And you walked away with $525. And then it just goes sideways. So beautiful trade there, guys. Beautiful trade. Let's say this was a little too expensive for you. What you could have done was you had the breakout, it pulled back and created this drop base rally. You could have taken a chance and said, okay, I'm going to put my stop right underneath there. It did end up pulling back in. and then taking off. And whenever you do something like that, you're increasing the risk to reward ratio. And look what happened. You caught the entire trade cost $188. That's 8 contracts, and you actually hit 5-1, and you walked away with $940. Okay, so very important to follow risk management properly because you will make more money doing that. Let's go to the next one. Let's go over to natural gas and take a look at what happened here. Now, natural gas was on here, right? Take a look. Here's the hourly. Here's the 4-hour. Let's grab a vertical line. And this is great practice for you guys because this is how you back test, okay? This is how you back test. You want to be doing this at least every other month and write down the data. This is what's going to give you confidence to take the trade. So what do we have here at the very beginning when the lines form here? Upward momentum, upward cycle. We even have an upward trend. So going back to the last video that we did, guys, remember when I was talking about what is a correction and what is an impulse? Here we have an upward trend on the high time frame, and we're in an impulse movement. Why? Look, impulsing up with the trend. This right here is a correction because we're in an uptrend. The pullback in an uptrend is a correction. The impulse going with the trend is an impulse. Okay, so right now we have an upward momentum with a impulse going in the direction of the high time frame trend. Very powerful stuff. So that is something you really need to pay attention to. So going to the middle chart, the 1-hour chart, we also have upward momentum. We are at the very top of that cycle, but it is impulsing up nonetheless. So we're expecting this thing to break out to the upside. If it breaks out to the downside, something's fishy, right? Then we might be looking for some kind of a bear trap or even a Globex trap, okay? But with the opening range, you want everything to make sense. Upward momentum, upward trend, therefore, breakout to the upside, we will take the retest to the upside, all right? And that's exactly what happens here. So remember, when I'm back testing this, I have found 76% of the time, if you follow this process, 76% of the time, it's going to hit the 2-1. It did it on crude oil. And here we go. We have it here again. Let's do some math here. Let's grab our risk manager. Go to the beginning of the trade here. Let's put it over here. Okay, here we go. Here's your entry. Here is your stop loss. 1% of a $20,000 account. You're going to put whatever your current account balance is here, okay? If it's $5,000, you put $5,000. If it's $10,000, you put $10,000. And then here's where you're going to put your risk. We always use examples of 1%. So 1%, what's that going to cost? 2-1, 3-1, 5-1. Let's bring this all the way to the left. And we'll make it large so we can see it. Okay, so natural gas, this is not the micro contract. So look at this. Right here, we have an example of where it's too expensive. This is a $20,000 account, 1% risk. We cannot take this trade, okay? So what do we have to do? We can do two things. We would have to say, okay, we need to take a 2% risk. That would give us one contract. When you saw the breakout take place, this is the leg that caused the breakout. Let's just get rid of this for a second. Here's the leg that caused the breakout. When we pull back, what we could do is something like this. And there you go. So here it's saying at 2%, we could trade 2 contracts. Now you can go back to your 1% here. And there you go. So $192, that gives you 1% of a $20,000 account. Do you see how useful it is and how quickly I was able to do that? You have to make these assessments in the morning when you're going through the trade. Otherwise, you're going to be frantic. You're going to be, oh, should I take it? And you'll end up making a mistake and take 2 contracts, and it'll put you over. You just over leveraged yourself. Okay. You want to make sure that you are using proper risk management. This is the best way to do it. Okay. So here we go, $192. Very good. We take the breakout. We hit 2 to 1. We hit 3 to 1. We hit our 5 to 1. And it actually kept going. So let's do a little recap of risk management here real quick. And I know it's not the most exciting subject, guys. Nobody wants to do risk management, but this is super important. Okay. So let's say here's our trade. Let's grab a line. And let's say we took the trade. Here's our stop loss, right? Did I not say 76% of the time it hits 2 to 1? Right there. One contract, because we only have one contract here, you have to take the 2 to 1. So with one contract, that was your target. That's it. You're out. Okay. Now, this did happen very quickly. So it's very possible that you could have hit that 3 to 1 because this just blew right past that first target and hit 2 to 1, even the 5 to 1. This is all in one leg, guys. Okay. But again, with one contract, you have to take the 2 to 1. You can't just let this thing run. Why? Because probability is on your side. 76% hits every single time. 76%, okay, will hit that 2 to 1. If you only have one contract, you're leaving yourself open for more risk, right? Why is that? Because as you go higher, the probability goes down, it decreases, okay? You have less and less and less of a chance of hitting the next target. You never know, you're never going to know when that's going to be. So one contract, you got to promise me, one contract you will always take 2 to 1. If we had 2 contracts, how are we going to play this? Once you hit target 1, I want you to bring this just above break even. Once you hit target 2, I want you to bring this right here to target 1. Look what happened because you only had 2 contracts. So hit target 1, hit target 2, hit target 3. Hey, this is a day trade, buddy. Don't press your luck, all right? What happened here was it hit that last target. We went right to target 3 and almost took us out and then kept going. So as of right now, your target would be right there. Your stop loss would be right there, okay? Now, you can ride that up, but honestly, by the end of the day, you can just put your stop loss right there at target 5. Don't give any money back. No giving the money back. We want to put the money in the bank account. We don't want to take the money out of the bank account. We want to put the money in the bank account. So this is money in the bank right there. That money is in your bank account. Again, hits target 1, bring it to break even or just above break even. Hits target 2, bring it to target 1. Hits target 3, bring it to target 2, and then you can let that thing run to the end of the day or tomorrow morning. But At the end of the day, probability tells us we should probably put our stop loss right at that third target, and you will be very happy in the long run when you do this, guys. So thank you. I really hope you got in on these two trades today. They were pretty clear. Crude oil was a little aggressive, but it worked out. And natural gas was 100% a winner. Everybody should have seen that on their charts today. So thank you, guys. I will see you in the next video tomorrow.